Howdy there, folks. Welcome into today's video. It's a buy one, get one free today in this one. Two videos for me to react to. First one up here, Cashin. He's been in the market at least 612 years now at this point in time. We're going to hear what Cashin has to say on why basically the next few trading days are absolutely critical for the bond and the stock market. So want to hear what that man has to say. He's been around the block. He's seen, there aren't many people that actually went through the inflation of the 70s and 80s. This man is one of those, okay? He went through that situation, okay? Then I want to go ahead and react to this one. We haven't heard from Mr. Short Hills Capital, Steve Weiss, in quite a while on the channel, so I thought we'd listen to where he's at with the market, what he thinks going on, and all that fun stuff. So appreciate everybody joining me as always. New all-time high subscribers. We reach a 52-week high every dang week. I appreciate y'all being here pretty much every day. It's a new 52-week high. It's the hottest stock in the market. So appreciate y'all being here. Also, if you haven't joined my Patreon, make sure you get in there. That's going to be pinned comment down there. I just made moves in there today. I bought one growth stock. I bought another growth stock that's trading like a value stock. I bought a dividend stock here today. And I also bought a speculative stock today in the portfolio. So yeah, if you'd like to join in there and get access to all that fun stuff, then check out the pinned comment down there and enjoy. Alrighty, let's get into this.
Those yields aren't going down. Do they need a push? And by a push, I mean growth disappointments.
Well, we are at a rather critical area. It's important. Many of us had thought that we had a series of minor tops here in the 10-year around 41.10 to 41.25. They came up and pressured that again, and that spooked the markets a bit. The fear is if they push above that if they push above that 4,025 area, then we got to have a problem. And relative to the auctions call, the concern isn't about the individual auctions, but the supply. The government, the Treasury is going to have to issue more and more, and that's hopefully not going to crowd things out. That's the key fear, that we might be crowding out. So we're watching both the bond market testing, and for days now, the S&P has been testing a lot of moving averages between roughly 40 and 45. 35. So the key areas to be watching here.
Yeah, we've definitely been...
okay, so you got to definitely have patience with Cashin. If you've been in the market this long, yeah, you're not going to speak as fast and those sorts of things. So basically, he's watching the bond market obviously significantly, and especially because of what the government's kind of up to in relation to that, right? And he's also watching some of these technicals on the markets in general, right? More of the stock market and the S&P 500. And basically his view is this is a very critical next, let's call it, few trading days here that are going to ultimately set the market up for the next probably several months, okay? My personal opinions might be a little different. I actually think the market... I'm not saying what he says is saying it doesn't matter. It's just, in my opinion, everybody's really waiting on NVIDIA. It's been obviously the most important stock in the stock market this year, right? Everybody's waiting on NVIDIA's earnings, which are coming in about a week and a half from now, to get us some sort of confirmation about, is this AI thing actually real? Are you guys coming through with the numbers, which is a 1-2 quarter thing, and then it's done? Is it sustainable? I think that's what everybody's actually waiting on, is these NVIDIA earnings in a week and a half from now, and what actually goes on and transpires there.
In this range, overall, 30,000 feet, does this kind of feel like it's par for the course when you've chopped a lot of wood on the inflation front? You're not sure what's going to happen with the earnings or margins on the S&P, and it's August. Does that kind of indecision, does this all seem very familiar to you?
You sound like you're in the watering hole with some of us old-timers. It is August, sir, and that does stick out in everybody's mind. In fact, we're moving through the middle, and the middle of August sometimes sees changes. There are certain people looking for...
You ever just watch the clouds move across the sky? It's so beautiful. It's so cool, man. I'm just watching these clouds right now. They're just, they're moving. Hey, we don't get many clouds in Vegas, okay? It's special when it happens. It's magical. Magical.
Cyclical changes that you might be watching for key action on Monday and or Tuesday. I'd love to be able to tell you exactly which direction, but if I could do that, we'd be both on a yacht somewhere. So But historically, as we move into mid-month, you can possibly get some changes of directions. And the fact that we're testing and retesting both bond yields and the level in the S&P says that if there is a sudden change, if there's a breakout, then it could take the market by surprise, and you could have a big move. You almost saw one the other day when yields went down to 390 and then shot back up above 4, and it looked like that was going to move the markets a bit. They held back. So I think this, from now until next Friday, could be a critical time for both the bond and stock markets.
Yeah, Art, we were saying earlier, just the jumpiness, the uptick in volatility in the Treasury market often does keep the stock market back on its heels. Seems like.
Yeah, and a lot of people don't realize this, but I think it's important I say this. The bond market is extremely influential in what happens with the stock market. And you could say even vice versa a little bit. But, certain things can happen in the bond market and that can shake up the stock market in quite a significant way. And so I know a lot of times, especially newer investors in the market, they like to think like the stock market's just its own thing, running its own race, doing its own thing, when actually a lot of the moves in the stock market can be dictated from what is actually transpiring in the bond market at a particular time. So that is just, something I think that's important that we kind of state out there.
That's playing out kind of hour to hour. I also wonder, just more broadly, aside from just the calendar, we obviously are into August. We came into this period of the year when everybody first decided to call it a bull market, even after we've been up, 30% off the lows. A lot of the bears sort of capitulated. And right where that sort of even the presidential cycle starts to turn a little bit less friendly for the market. So, I mean, would you be kind of putting that into the mix in terms of handicapping where we go from here?
Yeah. By the way, that's a risk factor. Man, hardly anybody's even talking about that. The presidential election, right? Obviously, things will start to heat up there end of this year, and then obviously heat up in a significant way in 2024. And that's going to be crazy. I mean, we're talking about the main potential candidate on one side has so many serious, and I'm talking about serious legal things going on. We've never going to have seen an election like we're about to see in 2024. And that could be messy. That could be extremely messy. We'll see what happens there, but I don't think that's a risk factor that's being taken nearly serious enough, in my personal opinion.
Well, I've been doing this a long time, and I will tell you, whenever it looks like the book is over, there's one more chapter, and I think that's what we're seeing. The hedge funds and others were capitulating. You had some longer-term negative observers saying, well, we were wrong or we were off, and things are there. And while that's not usually the kind of capitulation you look for, usually you look for it in high volume and volatility, but sometimes it's collectively people saying, wait a minute, I missed a decimal point here that wasn't quite right. And so I think you're dead right. It looked for a while like the bulls were going to emerge victorious, and now they're saying, maybe we'll keep the champagne on ice for a while and see what happens.
Just want to note that things are improving here as we speak. The S&P has gone positive. The Dow is now surging 170 points. So we are recovering from some earlier lows. You've had a number of sectors turn positive, financials, material.
Actually, I haven't even looked at the market very in depth today because the market's been so kind of lame recently. It's just up, down, doing nothing. But let's take a peek. Let's see what's going on out there today. All right, let's go see what's going on with my stocks. What's going on here? What the heck is going on, Planet? Planet's the big loser for the day. Boo. What else is going on here today? Looks like Avant is the big winner for the day. Tapestry, you're not even one of my stocks anymore. Get off here. Honest, they're coming around. I have more faith in them today than I did last week. I can tell you that much. So they're slowly bringing it around there. Look at that. That's exactly the type of market we're in right now. Pretty much half my stocks are green, half my stocks are red. So flip and flapjack and lame this market is. Like, make a big move one way or another. Go up a lot, go down a lot, do something. Nvidia, more scared panic is coming in NVIDIA. Interesting. Very interesting.
Industrials joining some of the more defensive groups. Our energy still is at the top of the market for the week and for the day. And I do wonder, these oil prices hitting their highs for the year, whether that presents a risk or we should look at it as a good thing because demand is high, as we heard from the IEA today.
Well, I think certainly the energy stocks give it a boost. They've been lacking for a while, but nobody watches more carefully and professionally than you do, my dear, the currencies. And when the energy prices move up along with yields, that tends to move the dollar higher, and that tends to affect foreign earnings and a variety of other things.
Art Cashin has so much game, it's disgusting. It's not even fair, okay? Man's got way too much game. Okay, so I'm going to take this party inside the house because my computer, the fans are starting to run. I think it's overheating. I don't even think it's 100 degrees today. Apple, get your stuff together, man. Your computer can't even last in 92 degrees. Like, come on, man. So true story for you guys. Sometimes, if I'm going to record a video in the garage, at that set and it's summertime, I usually have to put this MacBook Pro in the freezer for 10 to 15 minutes prior. That way it's cool enough so as it heats up, usually by the time I'm done the video, the fans usually start running and it gets close to kind of overheating, but I get the video done in time. So a little, random thing there. Alrighty, next one up here, let's hear from a few different people, including Mr. Short Hills Capital, Steve Weish.
So Bill and Kerry just alluded to this idea that there's a consolidation happening right now. What does the consolidation look like to you? Because we're seeing signs that there are traders and investors who are, in essence, maybe mini rotating, if you want, right? Out of names in technology and into places like energy and healthcare. Is this the beginning of at least a bit of a mean reversion trade back towards some of those quote unquote value parts of the market?
Well, Dom, it's nice to see you. I think one of the things that you have to remember is that coming into this year, those two sectors that you just mentioned, energy and healthcare, were tops on the list for many investors in terms of which sectors they thought were going to outperform this year. And clearly we haven't experienced that. And so I think, number one, just looking at it from a portfolio construction standpoint, taking some gains off the table, to Kerry's point, there has been significant money made in, this top 7, 10, 15 stocks, whatever you want to call it. So I think that rotation makes sense. In terms of energy, certainly the
So first off, thank you for stating the obvious. I appreciate her doing that, okay? People act like that's been the talk. No, that's been the talk since like last year, okay? Now, I'll tell you the real reason why many of these sleepier sectors, industries, and stocks are having trouble performing. I'll tell you the exact reason, okay? This is so simple. Think about this. Right now, you can get 4 to 5% guaranteed on your money. So a lot of people look at that and they say, why would I risk putting my money in some of these slower growth, more value-related stocks that you're usually not expecting to get you outsized gains anyways, when I could put my money in a savings account, a CD, a treasury, and get myself 4 or 5+%? Like, why would I do it? And that's the way a lot of market participants look at it right now. And so that's why you see a lot of money, obviously, in savings accounts, CDs, 3-month treasuries, 6-month treasuries, 1-year treasuries, things like that. So people are just like, why is it worth it to buy something? Now, when growth stocks are performing well, because people look at those differently. They say these stocks have outsized gain opportunities. These stocks have insane upside long term. So it makes sense to buy those ones, even if interest rates are 4 to 5%. Now, if interest rates were 10%, if we were at Fed funds rate 10%, I could tell you even growth stocks wouldn't perform in that sort of market, because even then people would say, well, no, it's not even worth it for me to hold growth stocks. 4 to 5%, people say values and divs, I don't want any piece of you right now. 10% or above, that's when people say growth stocks, any stocks, I don't want a piece of any of y'all. Because at that point in time, why not just keep your money in a savings account, right? Why not just keep your money in CD and get all that guaranteed money? So yeah, very different depending upon where the Fed's keeping rates. If you're in a very low Fed funds rate territory, let's say you're at 1% or especially under 1%, then all stocks are gain, because people say I got to buy my values and divs. People say I got to buy growth stocks because we're in such a low interest rate environment, right?
economic environment is supportive of a rotation back into energy stocks. And I think that's what you're seeing there. And with healthcare, there are a number of different facets of healthcare, whether it's managed care, drugs, or disposables. Healthcare is a very wide, varied sector. We talked about this, regarding industrials earlier this week, but it's true for healthcare as well. So there's a lot of different places to play in healthcare, and a number of those have not participated. And so if you're thinking about just from an overall risk standpoint, taking some of your winners off the table, taking some of those gains and reallocating to places where if we do experience a broadening out, there is relative value from a multiple perspective. It's easier to find in those sectors like energy and healthcare than it is in other parts of technology, for instance.
Steve, do you feel as though after seeing what we saw with the consumer price index data and then what we saw with the producer price index data, so retail and business level inflation, do we feel as though, there's no such thing as an all clear in the market, but do we feel as though the macro picture is stable enough right now where people can feel good about where they are in the market, as opposed to fearing for a surge in inflation again and higher interest rates on the back of that and everything else?
No, I think there was something for bulls and bears in the numbers. First of all, you had a revision, so it was a little hotter, this report, but when you factor in the revision downward from last month, you're basically hitting consensus, right? And you've got to look at it on an average basis. Clearly, inflation's come down quite a bit, but you still have services inflation, which is being very stubborn. And I don't think you look at the market in just isolation. As we talked earlier in the week, you've got credit card balances, credit card debt that's going a lot higher. So our economy is driven by the consumer. It's plain and simple. 2/3 of it. That's true of most economies, right? So I think you can have comfort. I don't see a deep, dark recession, but you've also had some little dents in the Goldilocks scenario where you're trying to thread, all the Fed tightening with a soft landing, and what set up for that, as Bill talked about, what got you to these levels, which, by the way, just to correct something you said, interpreting what I said, market didn't get where it is on fundamentals, okay? It got where it is on momentum, and it's coming back now. Momentum's reversing. So no,
I could say that on the same side. I could say that for what happened in 2022. The market didn't get to where those stocks went to based upon fundamentals. You can't tell me Tesla's fundamentals were worth $400 a share and then it's worth $100 a share. You can't tell me Meta's fundamentals were worth $350 a share and then it was worth $88 a share. No, okay? So a lot of this year has been just a get back from the insane, sell everything, no one wants to buy anything we dealt with last year. And I think that's something that's probably not talked about nearly enough. It works both ways, on the overbuying side and the overselling side.
I think you take as much comfort today as you took yesterday if you're a bull, and as little comfort today as you took yesterday if you're a bear. So it's still, and that's what makes markets.
Now, Shannon, one of the things that Steve brings up an interesting point with regard to some of the drivers behind the inflationary story right now. He mentions the services side of things. One of the other parts that gets a lot of attention right now is housing, property values, owner equivalent rents. Basically, the cost of living from a housing and real estate perspective remains stubbornly high right now and hasn't really pulled back to a certain degree that can kind of aid that inflationary story. The housing market as a part of the overall stock market has been a momentum trade for various parts of the year.
And by the way, you can make an argument that that's the Fed screwing that up, right? Because the Fed raises rates so high, it ends up causing mortgage rates to go significantly higher, right? If you're going to build a new apartment complex, guess what? It's a lot more expensive if you're going to build it this year or next year versus building it, 2 years ago, right? So you can make an argument that the Fed is the one that's causing, let's call it shelter, to be in a higher place. Because if you're going to go build a new house, it is insanely expensive. Why? Because of where interest rates are at, because of what the Federal Reserve has done. If you want to go build a new apartment complex next year, it's going to cost you a lot more money, because now if you want to get debt to finance that, which is pretty much how everything's built, right, is on debt, it's an insane rate. And so a lot of people aren't even going to be able to do the math to say, I can go build myself a new apartment complex next year. And so you can make a very strong argument that the Federal Reserve is actually causing this dilemma, right? A lot of people don't want to move right now. And why don't they want to move? Well, because they're locked in at a mortgage rate of 3%. If they go buy a new place right now, they're going to be at a mortgage rate of 7 or 8%. which dramatically changes your payments, and it dramatically changes how much you're going to owe on that home over time. So you could make a very strong argument that the Federal Reserve is to blame for this last sticky part of inflation around shelter specifically, which matters significantly, obviously, to all the inflation numbers in general, right? So that's something, that should be considered.
You think that housing story is in a consolidation or transition phase as well right now?
Housing is a very challenging area in that longer term, and this is not actually dissimilar to energy, but longer term, there's clearly an undersupply, particularly for residential housing here in the United States. And so
everybody talks about this. There's an undersupply of housing, undersupply of housing, undersupply of housing. Okay, let's say you believe that. Well, what's the worst scenario? Well, mortgage rates and loan rates being at the highest level they've been in 20 plus years. That's the worst scenario for that. Because if you're truly undersupplied, then you need to build. If you can't build, then that continues to be an issue if you really truly feel like we are undersupplied, right? Common sense.
Back of that sort of secular trend of and inclusive of the fact that millennials are beginning to accelerate household formation as they move past the student loan payment part of their financial life cycle. There are going to be fits and starts in the housing story. This constant give and take, if you will, as it relates to supply is offset, particularly in this environment, by the challenge of affordability. And so if we look at the housing market, what we really need to see is we got
to take a quick look at Bath & Body Works, see if there's something there. That one just flashed across the screen. I was like, Take a quick look here at Bath & Body Works. So stock's actually down about 5.5% in the past year in regards to this one. Oh, Bath & Body Works pays a dividend? I actually didn't know that. Interesting. I used to own L Brands back in the day, years ago, and they owned Victoria's Secret, Pink, and Bath & Body Works. And Bath & Body Works, by the way, was always like the crown jewel of the whole company. Dang! Trading now low valuation metrics. Woo-wee! Oh, man. Bath & Body Works. What do we got here, baby? Oh, we might have something. Ooh, Bath & Body Works. I see ya. All right. We might have something there.
a reset of expectations in terms of affordability and mortgage rates going forward, which probably means, to be honest, that we need to see expectations for rates to come down at least modestly in order to increase that affordability. But I think, as it relates to housing, there's a mobility aspect of this that remains somewhat unclear. If you're thinking about, yes, we're building houses, and who's buying those houses, it, in many cases, is going to have to be new entrants into the housing market, not existing home buyers, because they are anchored to very low mortgage rates. And so I think trying to figure out, specifically where this housing growth is going to come from, how these companies are going to be able to monetize that, and what types of customers and clients this, going after, sort of with some of the high-end homes, for instance, where you would be required to sell an existing property and move into that. Mortgage rates are very prohibitive right now to be able to support an en masse trade. Good point.
Phenomenal point by her. I appreciate all that. Thanks so much for joining me, folks. Thanks for being subscribed here, new all-time high subscribers. Make sure you get my Patreon. You get access to see the moves I'm making each and every week, which I just made 4 moves here today. You also get to be part of that Discord chat. Also have a new tier for you that has a course included in it as well. So if you want to join in there, check out the pinned comment down there. Much love as always, and have a great day.